Yes, hey everybody, nice to be here. I think you all have got a good introduction to decentralized insurance. We are Bright Union, a Dutch and Amsterdam startup. We're based in Amsterdam and Utrecht. And we are a decentralized insurance aggregator, Bright Union. This is Kirill, he's our co-founder and tech lead. And yes,
Hi, hello, yeah. Thanks for the introduction. Yeah, so we are Bright Union, exactly. So a little bit of background how we started. So we basically live since early 2021. Back then, we've been in the decentralized insurance world for a couple of years, actually. What we noticed in the early 2021 is that the landscape or the concept of decentralized insurance became quite popular, right? So back then we had well, 5 minutes ago, we had Nexus Mutual. We also noticed well, insurers started to appear, and then some others, Armor as well, guys over here. So, and we came to the conclusion that, okay, so the problem is clear, right? The problem is the risks in DeFi. Yeah, and so, but how to fix that, right? So risks are insane, or big or small, we don't know. And there were few solutions out there which try to tackle it in different ways. So basically they call themselves, actually they don't call themselves insurance because of the, I don't think, I missed the speak of these guys before, but I don't think they call themselves insurance. Anyway, but the point is that they tried to fix the issue of high DeFi risks. And how they try to fix that, all totally different. Someone came up with the idea of cover. Some came with the idea of embedded insurance, but they've been tackling the same stuff altogether. So back then we thought, okay, so it's a complex task, but the solution are not simple either. So what if we come up with some common layer for the customers who wants to buy a cover, and basically try to compare all the solutions to make it explain what the benefits they have. Because as I said, they all do they have slightly different terminology. They cover slightly different risks. Some of them are saying we cover rug pulls. Some of them say we don't. Some of them you need to have a cover. Or maybe for some of the products out there that you are insured on side chains, you have the cover on Ethereum, but you also covered for now on BSC or Polygon, etc. So that's how our idea basically started. We decided to come as an aggregator. So basically we call ourselves, sometimes we call us 1 inch of DeFi insurance. All right, so we built the app early last summer. It's live since, and we have 3 partners integrated with already. So we have Nexus Mutual, Insurers, and Bridge Mutual. There are a few in the pipeline, will be coming soon. So basically people can come and compare the covers. But since after that we decided, okay, so that's clear, right? People can now compare, but the concept of decentralized insurance is basically quite interesting, because it's not only about buying the cover or protecting their risks, it's also about providing capital, and buyer risk basically earn on their capital. That's what typical insurance company always been doing. The only difference is that instead of the company, we have a code, right? So people can, as I said, provide the capital and start earning on sales. And again, so if you heard the guys before, they also have different ways of people provide capital and take the risks. That's how actually idea of, and we thought about this for multiple months, and we launched the product, the synthetic asset, which we called it Bright Risk Index, where basically under the hood people can provide the capital into there, and we will distribute the capital around across our partners, right? So you become the ultimate insurer. And if you think about this, it's just mind-blowing, because, so give an example of traditional insurance. There is the Allianz out there, and Munich Re, and this and that, and Delta Lloyd, etc., etc. But there is no single way how you as the individual could provide capital to these insurance companies and start earning some return yield. That's exactly what we solve.
Yeah, so we're trying to make, for you as an investor to replace the insurance company, we're trying to make that super easy. So with the Bright Risk Index, I think he's setting up the presentation. If you want, if you're ready, just let me know. With the Bright Risk Index is the easiest, safest, and the most diversified way to act as an insurer. So that means that you become a risk underwriter. And right now, this is a very unattractive investment opportunity, because if you are an underwriter, for instance, Anchor, and Anchor gets hacked, you lose all of your collateral. So what we built is a Bright Risk Index. And it is integrated with 3 different risk partners, and it was diversified over more than 100 different risk protocols. So that means it is a very interesting risk-reward ratio. So right now, what we offer is an opportunity of 15 to 25% APY on stablecoins.
Yeah, let me take over. Hey guys, Chris, operational lead with Bright Union. A bit of an impromptu speech, so I was just on the bike rushing here to be on time. Unfortunately, I was late. The weather is getting cold as well, so yeah, you guys were very lucky last week. All right, so Bright Union, right? So we're trying to help shape the future of decentralized insurance, from crypto coverage to metaverse asteroid collision insurance. So we try to become the 1-inch for decentralized insurance. These guys already talked to you a bit about this, and the goal for me is now to explain a bit more about the Bright Risk Index. Let me move over to that part of the presentation. So, the Bright Risk Index is an investment opportunity within decentralized insurance, right? So the cool thing about DeFi and distributed ledger technology is that it can democratize a lot of activities in the current financial space. So if you look at insurance companies in general, they have a pretty profitable business model. Look at all the big buildings in all the cities, in Stuttgart, in Amsterdam, the Egons, the Achmea's, the Allianz, all very profitable. So that's why it's super cool that you can now act as an insurer. But what is paramount for insurance to work? Does anyone know here? What's the key thing you need as an insurance company to thrive? Maybe Kirill, you know.
Capital?
That's one. Ah, I see someone here. Risk modeling, yes, that's a very important one. Not the one I'm looking for right now, to be honest. All right, diversification, the law of the great numbers, right? You need to have a risk portfolio that's so diversified that a couple of big claims or events cannot wipe out all your capital. Diversification is key. The cool thing about DeFi is the Lego blocks. Everyone knows the composability. So what you currently see within decentralized insurance, that too often it's not diversified enough. You can stake one-on-one on a pool with Anchor, one-on-one in a pool with Aave, or you can stake in a couple of pools, but still the value at risk of your capital can be quite significant. So that's why we as an aggregator thought it was a good idea to build this super diversified pool of risks. So look at this picture, what do you think? Probably the same as I do. Quite complex, right? I mean, and that's what we do at Bright Union. We try to make it simple for you. So the BRI, it works as follows. You deposit DAI, which is then put into a tokenized position, the BRI, and the DAI is subsequently deposited over 3 risk platforms and protocols in 150 risk pools. So there you have it, 150 risk pools means it's super diversified. Not a single claim can have a material impact on your deposited amount. The maximum value at risk with the big black swan event is only 12%. And in return, you get 15 to 25% APY annualized. What also is very cool about the BRI, I'm a bit biased, I know, is that it helps solve one of the key issues in decentralized insurance. Decentralized insurance, I think, is one of the sectors within DeFi which has the least traction up until now. Farming, automated market making, lending, everything's skyrocketing, and decentralized insurance is still trying to breach through to get mass adoption, but it still isn't there. I think I heard it Cynthia mention already in a while ago. One of the key challenges is capital. Kirill said it as well. What do you need as an insurer? Capital, right? So it's decentralized, it's permissionless, so you guys, as the crypto community, can act as an insurer. So why aren't you massively acting as an insurer? Does anyone here underwrite risk pools? Is anyone investing in decentralized insurance? I see 2 hands over there, but quite frankly, I know the guys, so they don't count. All right, we believe one of our theses is that because it's just not user-friendly enough, right? So we all know it. If you stake, you have the withdrawal periods, you have the cool-down periods. If you take your capital out prematurely, it's being slashed. And let's be honest, no one likes to put their capital into custody of a smart contract they don't fully understand and grasp. I think that's one. And then 2, is the diversification. It's super important to be diversified as an insurer. If you're not, yeah, your capital is just at risk. So that's 2. And then the 3rd one, gas fees, right? Staking, unstaking, Ethereum, we all know it. It's a pain in the behind, nobody likes it. So that's why we, with the BRI, we pool the funds and we stake it in efficient transactions for you. So maybe a lot to take in. Key highlights, Bright Risk Index. You can become a decentralized insurer in a diversified manner, which is super user-friendly and easy, and it earns you around 15 to 25% APY annually, right? Maybe one nice comparison you see now with stock markets. I know a bit of a dirty word here. It's a bit in turmoil. Everyone's escaping from the high growth stocks and looking to invest in the more stable, conservative stocks, like utilities, like energy providers, like insurance companies. Now, imagine here, you can invest in an insurance company without all the administrative overhead. You just invest in the risk pools which are out there with a super nice risk-reward ratio. All right, I think that was enough shilling for now. Back to you guys.
Yeah, maybe some questions.
Yes, go ahead.
Yeah, good question. I think that ties in a bit with what the lady said over here, risk modeling. What you often see with Anchor is that the capacity is sold out, right? So with the underlying risk platforms, they do the risk modeling, right? And they calculate how much insurance can we give out given the capacity that we have. So at some point, it's just at a hard stop. So I think right now, like 200 million of the capital in Anchor is insured, and not more. So if something happens, the USTD pegs or there's security breach, those 200 million could, well, draw under the insurance, but the remainder cannot. And that's, again, one of the problems the BRI tends to solve, just to boost the capacity within the industry. Yeah, good question. I'll give that one to the techie who has a strong opinion on this.
Doesn't matter in the fact. Actually, it doesn't matter because, as I said, there are around 8 positions that BRI actually invests into. So 3 decentralized insurance protocols, all different currencies. So under the hood, we do swaps for 7 out of 8. So potentially we could add support of shitcoins indeed. Anyway, they'll be swapped to stables, so it doesn't really matter. We try to make it, basically we started with low risk, low return, although return quite low, high now, unexpectedly. But
Go ahead.
yeah, so we launched that with the idea of being the, offering best prices on the market. So we don't charge anything on top for the buyer. So the whole idea was to have it always lowest cost. Actually, it's even lower because we have some loyalty, our loyalty, internal loyalty system, so we can even have a discount on that. So we 1 inch, right? So we are trying to make that the most efficient and cheapest on the market. So our earning model is from their protocols themselves. We have the referrals and stuff like that.
Yeah, there in the back. No, that's you, yeah.
Yeah, it's about, again, about risk modeling, right, we are talking about. So I have a little bit of background with the solvency regulation, so the idea of how to become solvent and so how to calculate the risks under the hood. And okay, the honest answer, we don't know. And even more honest answer, so if Ethereum is down, because there's mergers coming, right, I mean, basically all protocols will be hacked. Right, it means there is it's called concentration risk, right? How concentrated it is. We try to solve it, not ideally, but still we do a little bit of custodials, right? A little bit of DeFi, mostly blue chips, but a little bit of shitcoins, of shitcoin protocols. Yeah, but it's still Ethereum, right? So merge is there, all down, hopefully not. But yeah, or exactly, well, there is a little bit less risk is like bridges, cross-chain bridges. Some of them heavily rely on wormhole, the bridge, other bridges out there. It is a huge concentration risk. DAI itself, right? I mean, that's, if DAI is losing the pack, we know all the rules, how they will prevent the liquidations, and then the posts, and then this, that. But if DAI is down or stuff like that, yeah, it's a risk.
Maybe to add on top of that, I mean, if you look historically, I think there were a couple of claims which were eligible and paid out under insurance, for example, the BZX and the Cream Finance. And then if you look at what amount was actually insured and what percentage thereof was eligible for a payout, was roughly around 10%. That has to do with a couple of factors. One is that generally not all funds are exploited, and you have to prove loss. And then second, you see some people already exited their position. They were able to prove the requirements. So you see that the amount that's actually being paid out is fairly limited. So far, but indeed, if Ethereum goes down, yeah, we don't know. Black Swan event. I think we all go home if that happens here, right? I mean, yeah.
So no, we don't. We take DAI, yes, but don't convert. So we diversify over the protocols and the currencies. So we have USDT, USDC, DAI, and a little bit of NXM, Nexus, and a little bit of Insure from InsureRace, stuff like this. But 80, 90, more than 90% are in stables, but three stables. DAI is, why DAI at the first place? Well, we are Ethereum maximalist and blockchain maximalist, honestly. We don't have any server side. We are fully on chain, so maybe that's why we've chosen their most algorithmic, let's say, stable as a base, but yeah.
Good question.
His question is, would you also use a euro stablecoin?
No, we don't, no. Euro stable, I'm not even sure what it is. Euro is stable, right, on my bank account. Anyway, no, sorry. So It's not up to us to decide which currencies to take. So as I said, under the hood, we are dealing with the insurance protocols, right? The ones you've seen before over the time. So whatever they use, we just stick to that, right? So. Does this answer your question? Perhaps not. I have a feeling.
I think how we foresee the future is that indeed there will be multiple versions of the BRI, right? I mean, this is, let's say, V1, one basket, but you can have a second basket and a third basket, which can be based on European stablecoins, or which can be a bit more high risk, or which can be for the anchor Deegan who think it will never get hacked. I mean, there are many variations possible, indeed. But this is the initial setup we've chosen for now. Yeah.
So we aggregate insurance companies, right? So we are not dealing with the protocols themselves. We are selling on behalf of these guys. We are selling the covers, insurance covers, right? So they're. Again, I missed their speak before, but actually risk is unknown. If they tell you that the risk of Aave being hacked is low, that's not entirely true. So if you ask any quant out there from traditional insurance world and you try to explain them how you measure the risk, they will get crazy, because honestly, we don't know these freaking risks in DeFi. We don't know. We don't have historical data. We cannot run Monte Carlo simulations. We cannot do anything out there, right? In best cases, we know the team behind, but not always the case even. So it's just crazy. And honestly, that's why perhaps the covers that people buy are quite expensive. They are from 2 to 5% of the capital. So if you want to insure your $1 million put into Aave, then it will cost you $20,000 or $30,000, which is quite expensive if you compare it to the price you pay for your house or insurance. So risks are unknown. And honestly, we are in the position that we don't have to solve it, because these guys are solving it in the way they want. We just stay on top and follow the market.
But maybe to add again, we do, of course, due diligence on our partners, both operationally but also technically. And our smart contracts are vetted by security audits, of course. So yeah, I mean, security is very important. We don't know how big the risks are. Something could always happen, but we take it very seriously. So I think that's also why we launched the BRI in a phased approach, with security measures and then reaching a couple of milestones, increasing the investment cap. And after the audit, now it's commercially available. Yeah. Two guys there, yeah. First the back one, it was a little bit earlier, yeah.
Repeat the question. Repeat the question.
So your question is, what is the threshold? When is it too much?
I personally feel that the cross-chain bridges will be a big game changer, perhaps, on all crypto market, because the cross-chain bridges, the way how they implement it at the moment, they're honeypots. They store a shitload of money out there, and they implemented not in the best form. They are all quite. It's just. I feel it's like quick fix patch to this cross-chain issue or problem we currently encounter. So I expect, and as I said before, the breach or major breach hack might influence a lot. Yeah, as I said, as Ethereum maximalist, basically my favorite one was Wormhole, and by irony, that the one was hacked. Terrible, actually. But hopefully it will be back. It is back.
I think we have time for one more question in the back.
Sorry, do you mean APY on their investment part? Or yeah.
So your question is, how did you end up with the APY that were...
I don't know. It might be. I mean, if you calculate, basically, again, 20% APY return is if you act as an insurance company, right? Insurance company, they earn a lot of money, traditional ones, right? Why? Because they try to come up with some risk models here. They leverage some positions because once they diversify enough, they can leverage because the risk is still fine and they still remain solvent. Honestly not. I mean, if you look at our partners, that the return they get if you put money in, it's a little bit, or sometimes, or some of them, it's inflated by their own governance token. Typically, I mean, it's freaking DeFi, right? The return is actually not as high. They try to build up quickly the TVL over there. It's a capital, right? If you're insurance protocol, you need first capital, then you can sell. You cannot sell before you have capital, right? So in order to get a lot of capital, especially for guys like Anchor, because they constantly have not enough capital, they inflate it a little bit with their own token. Whether it's good or not, no, not perhaps. Or at least not sustainable. It's definitely sustainable in longer term. But for the time they on the market for like a year, then it's all rightish. So honestly, I noticed today we have APY of like 50%, but it's because of some of our partners leverage money a little bit. But average is around 20. Yes, it will go down. It will go to, I expected like maybe 10. Honestly, still fine.
Time's up, I believe.
All right, thank you very much.
Thanks. Cheers.
Thanks for listening.